Brand new one from Pink. Walk Me Home. 8:17 here on the Den. If you're walking anywhere today, make sure you're covered up. Although, you know what? Later today, not too bad. -7 with a wind chill of -10. Still well below seasonal temperatures. But tomorrow, back up to where we should be, 0 with a wind chill of -2. Heating it up right now. Tax time, almost. Well, actually, it's tax time all the time when you think about it, because you should be preparing and be ready by the time the official tax time rolls around. Helping us this year is the Mad Accountant. Yes, he is in once again, Owen Tulk. Good morning, sir.
Good morning, Dan. How are you?
Good. Pulled an all-nighter last night, did you?
Yes. I'm really busy right
That's
now.
when I know it's tax time.
Yeah.
When you talk to the accountant going, I have stuff, yeah.
And I don't drink coffee.
Oh, gee. See, there's your problem. Welcome to morning radio. It is literally our lifeblood. Keeps us moving. Now, we talk about personal taxes, but we've also been talking about the business side, and that's what kept you busy right now, because there's a bunch of deadlines, right? The 28th?
Yeah, I have some deadlines just because I have some corporations that needed some stuff filed by tomorrow, and so I need to make sure.
And that would be the quarterly filings, right?
These are annual, actually.
Oh, annual one?
Companies,
Okay.
Yeah.
Oh, I see. So year to year.
Bunch of different stuff.
Well, listen, let's talk a little bit about tax deductions. And as I mentioned a little while ago, I was flipping through the list and went, oh, I had no idea that was tax deductible. And I guess, is this a mixture of business and personal, or more business?
It's just an assortment of things. I mean, I try and come up with something interesting and that will actually be relevant to a different perspective for people, right?
Right. Yeah, because, having been in the television industry, used to, we had to watch when we had our suits and things like that, because that's actually a tax benefit. You can't write those things off.
No.
And many people think you can write it off, but if you use it for work, you can't write those things off. However, if you own a business and you have gym memberships, there's a possibility to write it off.
There is. So a lot of corporations have only one employee being the owner of the corporation a lot of times, or maybe they have their family members involved, or maybe a few other employees. But being the time of year it is, I guess everybody's heading to the gym, so this is a good time for this one. If you put the membership in your corporation name and you make it available to all of your employees, whether that be 1 or 21 or 101, then that is a tax deductible expense for the corporation, and it is not taxable to the employee either.
Okay, so you have to make it available to everyone.
Yes.
Right. You can't just make it individual here or there.
Correct.
Everybody has to have
no elitism.
Right. Has to have that opportunity. Private health plans, how do they fall in at tax time?
Private health plans, again, a lot of people that own corporations is just for themselves or maybe a few employees. But if you have like a Blue Cross private health plan, that once again is also deductible and can be paid on your behalf. Unfortunately, for larger corporations, you have to pay EHT, which is the employer health tax, otherwise known as OHIP. And funny enough, that is not tax deductible because it's through our government.
Now, what would you classify as a larger corporation then?
Anything over $500,000, basically.
Right. So that
in
is
salaries.
In salaries.
Mm-hmm.
Okay. Per year.
Mm-hmm.
Right. Okay. Family income splitting and loans to the family. Now, this is both personal and business?
Yes. Well, basically, as an individual, if you're a high net worth individual and you were trying to, I guess, lower some of the tax you pay on your investments, and it depends on the type of investments because there is a cost associated with it. But you can loan money to your family or friends or anyone you like, but you can loan money to your family and have them invest the money, and then the tax and the income associated with the investments and the associated tax will also go to those people. The one thing is there is a prescribed rate of interest that has to be paid once a year, and that's 2% right now. It was 1% up until mid last year, which was amazing. So you could lend someone in your family $100,000 and let them invest it, and they get the income and they pay the tax and everything on it. and you would only have to be paid 1% interest on that investment.
Right, and now it has to come through the system, obviously, then as in a return at now 2%.
That's right.
Right, so there it has to be somewhere on the books that you're receiving the money back.
That's correct.
And again, at a 2% rate. Labor-sponsored venture capital corporations. Now, this isn't for the everyday Joe or Josephine.
It can be. It's not widely known. They were quite big, actually, in the 90s, and they were significant tax credits and tax breaks in the 90s for them. They have backed off quite a bit. But it's another type of investment. It's like a mutual fund, basically. And you can put it in your RSPs, TFSAs, or outside in an unregistered investment account. The benefit of having one of these labor-sponsored venture capital corporation funds is that you get an additional 15% federal tax credit. So that's quite appealing. And the one thing about these is they are usually a little bit more risky, and you want to do your homework. And if you have an investment advisor, that's clearly the best way to go. But you can talk to them about it because there is additional money there on the table for you from your taxes.
So these are smaller companies that there is that risk, but you're trying to help them get up over that hump, and it's probably a Canadian company.
Like I say, it's venture capitalists, so it's they're investing in things that, people aren't able to get their funds elsewhere. So
right, so they're chipping in, and it may be a business that's down the road from you. You never know, but as you mentioned, a little riskier. Make sure you talk to somebody before you get involved in something like that. This is the one that turned my head. I didn't realize. Interest on student loans. It's a deduction?
It is. If you pay the interest.
Right. Which you would try to avoid.
That is the key.
Yeah.
You have to pay it. But yeah, when the students come out of school, unfortunately, a lot of them end up with these huge student loans, and there is interest associated with it. It's usually a lower rate, but there is interest. And once you've paid that interest, it is a tax credit. It's a non-refundable tax credit, so it's not a dollar for dollar deduction. So